What if I told you Elon Musk can access billions of dollars without selling a single share of Tesla or paying a dime in income tax? Sounds illegal, right? It's not. In fact, it's the billionaire playbook, and it's all 100% legal. Offshore trusts, tax-free loans, Delaware shell companies. This is how the ultra-wealthy live in a different tax universe than the rest of us. And today, we're pulling back the curtain. Welcome to Hedge Haven, where we decode the secrets of the ultra-rich so you can protect and grow your wealth like they do. Let's get one thing straight. The tax system wasn't built for the average person. It was built by the rich for the rich. While middle-class employees pay income tax on every paycheck, the ultra-wealthy structure their income so it never looks like income at all. They don't earn, they own. And ownership changes everything. Jeff Bezos, Warren Buffett, and Elon Musk have all legally paid less tax, in some years zero, than most salaried workers. How? Because tax law rewards those who understand leverage, asset control, and jurisdiction arbitrage. Warren Buffett once admitted he pays a lower tax rate than his secretary. That wasn't an accident. That was strategy. It's time we understand how this game is really played. Because once you see the blueprint, you can start making moves too. Here's how Elon Musk does it. He owns tens of billions in Tesla stock, but instead of selling it and triggering capital gains tax, he borrows against it. That's called a securities-backed loan, and it's genius. Let's say Musk wants $1 billion in liquidity. Instead of selling stock and paying 20 to 37% in taxes, he takes a loan from a private bank using his shares as collateral. The interest is often under 2%, and there's no tax event. Why does this work? Because loans are an income. The IRS doesn't tax borrowed money, even if you're living off it. And if your stock keeps going up, you roll the loan over. If you die, your heirs inherit the stock with a step-up in basis, meaning all those taxes vanish into thin air. Musk didn't invent this strategy, but he's perfected it at scale. And the best part? You can do this too, on a smaller level, if you hold appreciating assets. Now let's talk about the most powerful tax-free account in America, the Roth IRA. In theory, it's meant to help regular people retire tax-free, but Peter Thiel, billionaire co-founder of PayPal and Palantir, figured out how to turn this humble retirement vehicle into a $5 billion tax fortress. How did he do it? In 1999, Thiel used just $2,000 of his Roth IRA to buy founder shares of PayPal at a tiny valuation, pennies per share. Fast forward to PayPal's IPO and explosive growth, and that small investment grew into billions. Because it was all inside a Roth IRA, he owes zero in capital gains tax. Not now, not ever. This isn't tax evasion, it's tax optimization on steroids. The IRS has since called this move into question, and new laws are being floated to stop this kind of mega Roth strategy. But it's too late. Thiel already won. This loophole shows how early private equity deals and tax-sheltered accounts can be weaponized together. The ultra-wealthy use time, compounding, and legal vehicles to build dynasties, while most people max out their IRAs with index funds and hope for 7% returns. Let's now dive into hedge funds, the playground of billionaires and sovereign wealth. The average person sees headlines about hedge fund profits, but they don't see the structure behind the scenes. The most common setup? A master feeder fund. It works like this. You set up the master fund offshore, let's say in the Cayman Islands. Then, two feeder funds are created, one for U.S. investors in Delaware, and one for non-U.S. investors, also offshore. All the money flows into the master fund, which makes the trades. But here's the magic. Profits earned offshore may not be taxed in the U.S. if they come from foreign investors or certain deferred income streams. That's why 70% of all hedge funds have Cayman entities. Not because it's shady, but because it's efficient. Then there's the carried interest loophole, the holy grail for hedge fund managers. Instead of being paid a salary, managers take a carry, a cut of the fund's profits. That income is taxed as capital gains at around 20%, instead of ordinary income tax rates of 37%. It's legal, it's been defended in Congress for years, And it's how hedge fund managers earn tens of millions while paying the same rate as someone flipping houses. Now we enter the real maze, the legal shell game of asset protection and anonymity. Picture this. A billionaire owns a $50 million mansion in Malibu, a private jet, and a Picasso. Yet none of it is technically in their name. How? Through a web of LLCs, trusts, and nominee structures. Start with LLCs, limited liability companies. A billionaire doesn't buy the asset, their LLC does. And that LLC might be owned by a trust, which is managed by a trustee, often in a tax haven like the British Virgin Islands. By the time you trace ownership, you've gone through 5 jurisdictions and 6 layers of legal opacity. Good luck finding the true owner. Delaware is a favorite for US LLCs, not because of secrecy alone, but because it doesn't require disclosure of beneficial owners and has favorable business laws. Wyoming and Nevada are rising stars for similar reasons. Then come the trusts, especially Dynasty trusts and offshore asset protection trusts. These can legally shield wealth from lawsuits, taxes, and even ex-spouses. Some billionaires move assets into irrevocable trusts in places like the Cook Islands, where even US courts can't force a payout. This isn't about hiding wealth illegally, it's about making it legally unreachable. What does Switzerland, the Cayman Islands, and Singapore have in common? They're not just postcard destinations, they're tax optimization hubs. The media calls them tax havens, but professionals call them tax-neutral jurisdictions, and that's a key difference. Let's say a hedge fund generates profits in the Cayman Islands. There's no local tax, no withholding tax, and minimal reporting. If you structure it properly, that income can flow back to the US investor deferred or recharacterized. Multinationals use similar setups. Apple's infamous double Irish with a Dutch sandwich saved them billions using Irish and Caribbean entities. Offshore banking also offers currency diversification, asset protection, and investment privacy. You don't need to be a billionaire to open an offshore account, but the ultra-rich use these tools to create legal firewalls between themselves and risk. Now we arrive at the ultimate tax strategy: buy, borrow, die. A method used by billionaires to grow, enjoy, and pass down wealth while legally avoiding income and capital gains taxes. Here's how it works. 1. Buy appreciating assets. Stocks, real estate, startups. Hold them, don't sell them. This way, you avoid triggering capital gains tax. 2. Borrow against those assets. Need $20 million to buy a yacht or fund a new startup? Take out a low-interest loan using your portfolio as collateral. It's not income, so no tax. 3. Die, and this is where it gets really powerful. When you die, your heirs receive the assets with a step-up in basis. That means all the capital gains you deferred vanish. The new cost basis is the market value at the time of death. So if your heir sells it the next day, 0 capital gains tax. Elon Musk has used this exact method. Despite being worth over $200 billion, he's borrowed against Tesla shares rather than sell them, minimizing taxable events. It's financial alchemy. Use leverage to live like a king, avoid taxes like a ghost, and pass wealth tax-free. Now, you may not have a billion-dollar hedge fund or an offshore trust, but the core principles can still apply. Use tax-advantaged accounts like Roth IRAs and HSAs to shield gains. Buy assets that appreciate, then borrow instead of sell if you need liquidity. Use LLCs for real estate or side businesses to access deductions and liability protection. Understand your country's capital gains rules and estate planning tools. The game isn't fair, but understanding the rules puts you in control. The ultra-wealthy didn't get rich just by investing. They structured their wealth to work with the system, not against it. And that's what we do here at a Hedge Haven. Decode the blueprints of the rich so you can start thinking like them. If you found this video eye-opening, don't just scroll, subscribe for more real strategies used by hedge funds, billionaires, and global elites. Like the video if you learned something new, comment what strategy shocked you the most, and share this with someone who thinks the tax code is fair. The next video, we're diving into how billionaires use life insurance to avoid estate taxes, and trust me, you don't want to miss it.